perspective in terms of how we think about valuation and how we think the market's been changing, our business has been about really creating a house of brands. And we've been doing it in a very methodical way. So if you look at this timeline here, we've bought about one business per year, which I know is very different than probably some of my counterparts on this call on the Amazon side. But we bought Homesick in 2018, Kalo in 2020, Gravity in 2021, and Love Your Melon in 2022. Collectively, they cover three segments: home, sport outdoor, and wellness. And very interestingly, we bought our first bolt-on acquisition, MyHigh, which was Gravity acquired back in May of this year. And the reason I highlight this is, for us, we really focus on larger size assets with a really strong brand and community. So if you go to the next slide, kind of gets into the criteria of how we think about things, which is at a very qualitative level. We look for brilliant founders, great management teams, because they often do join us on the other side of these transactions. Strategic fit, which in some cases is what category they're in, but generally that they're category leading. And then lastly, there's an emotional connection with the customers. And that's usually something, one signal there is repeat rates on purchases. Again, these businesses tend to be direct first, in our case, 60% direct, but very quickly we extended them into the Amazon and the wholesale channel. So that's kind of the qualitative view of how we look at things. If you go to the next slide, we can kind of get into some of the quantitative. Now, I won't go through every line on this slide, but I will kind of highlight how we think about valuation and how we think about assessing these businesses. Effectively, there are 5 buckets of analysis we're doing: revenue channel expansion, gross margin expansion, marketing efficiency, operating expense, and financial leverage. Those are the things that we're looking to see. Can we make improvements on the other side? The metrics on the far right are examples of target metrics I would consider you're in a very strong position. So for example, gross margins of 60 to 70%, that's great, that's amazing. We'll look at businesses where there's 50% gross margin. If we see a business that has 40%, even if we were to resource it, there's probably something fundamentally wrong in that business, whether it be a pricing issue, a discounting issue, or sourcing issue. It's going to be harder for us to get there. So this gives you a framework of what you want to see your target metrics at that would point to the higher side of our valuation. If you start to see marketing costs of 30, 40%, one, I'm going to assume there's something wrong in the business, but two, it is also telling you that you're going to look at a lower valuation from our standpoint because there are issues in marketing efficiency. The one danger about looking at these metrics is the opposite can be true. So for example, let's look at customer repeat rate. If we see 50+% customer repeat rate, you might say, oh, it's amazing, our community is super engaged. But actually it could mean the opposite, meaning your acquisition funnel has dried up and you're retargeting to your existing customers, and this business may be on a downward spiral. So those are some of the signals we tend to look at as we think about where does this sit in our valuation range. If we go to the next slide, we can talk about how do we think about valuation. And, really, this is, kind of sounds like investment banking 101, but there are 3 components that make up a valuation multiple: the size of a business, the growth rate, and its ultimate margin. And if I look at the current state of the market, in general, what we see in the branded businesses we're looking at is the mid-market. If you're a business sub 50 million, it's very hard to trade on a full acquisition. You might find a growth investor or someone to come in. We can go into what that means in a few minutes. But generally, it's hard to exit when you're subscale, sub 50 million. At the same time, depending on what category you're in, it also can be hard to trade. So in the home category, for example, businesses that are less than 100 million often aren't very interesting to the strategic buyers because that universe is a lot smaller. From Wynn's perspective, we're kind of playing in that mid-market below. And we look at businesses, as I mentioned before, 5 to 50 million. We'll look at stuff at 20 million or larger, or we'll look at smaller things that are bolt-on. So great example, that MyHigh acquisition fit in the bolt-on category, and we're able to add that to an existing platform, in this case, wellness. So from our perspective, we're a little bit more flexible as we look at these things, and that makes us a unique strategic buyer relative to maybe other traditional PE, et cetera. When you look at growth rate, and this is probably the thing that most brands are struggling with right now, especially in the D2C and even Amazon world, given the Facebook iOS changes last year, historical growth equity, PE, they want to see 50+% growth rates. When we target our businesses at 20%, we're fine seeing a business growing 5 to 10%. That's okay, because we're focused on long term. We're not trying to buy a business and sell it in 3 or 4 years. And what we're really trying to figure out is what's the next decade or two to look like for this brand. And that's really important in terms of our lens, but also changes the framing of what we look for when founders are trying to exit. On the margin side, profits are always important. And this is becoming increasingly more so now, where you're seeing a focus on EBITDA multiples versus revenue multiples. Traditional PE, they're going to see 10 to 20%. Growth may look at 5%. But if you don't have profits, from Wynn's perspective, we can't even value you, because we look at things on an LTM EBITDA basis, because we want to see if the business works on its own. And then we can talk about all those points of improvement that I looked at the last slide, margin expansion, et cetera. So we'll look at things a little bit smaller, where our goal is to bring them higher, but we want to see profits. And the more profits you have with growth, with sizing, means you're going to be on the higher end of any buyer's multiple range going forward. You can go to the next slide. So some observations when we look at the market in terms of quality, pricing, and structure. So what is happening right now in terms of quality of assets we're seeing? I will tell you that we're seeing bigger assets trade in a range that we want, but we're also seeing a lot of lower quality assets hit the market. And what I mean by that is, during the diligence process, and this is a very frustrating thing for founders, the investors are always asking for updates on financials, because what they're trying to do is track how are you doing against your forecast. So I shouldn't say this because Emmett's on the phone, but like, you want to put your, your advisors always say want to put out the best, growth plan going forward. But the reality is, if you aren't meeting those forecasts, you're losing confidence from the investor. So what I'm put here is, I can think of in the last 4 out of 5 deals, we basically saw brands underperforming, and that really caused a problem in the process. From a pricing perspective, we used to see 8 to 12 times is what bankers would be pitching us. In the last 6 to 8 months, I'm seeing bankers and even founders kind of move towards that 3 to 6 LTM side. And then the last thing is structure, which is, you still can get a high valuation. That 10 to 12x could happen. However, it comes with structure. And 2 out of 3 opportunities that we followed up on that we passed, the structures were very punitive, high liquidation preferences, junior stack of equity. So you got to really be careful. Last slide. So what should you do knowing these things? You can skip the next one. 3 things I would think about in terms of optimizing your multiple. 1, focus on margin expansion over revenue growth. I know it sounds counterintuitive, but if the traffic's not there, the traffic's not there. I'm seeing a lot of businesses that are growing growth-wise, but their EBITDA is getting worse, and that actually tells me the business is that's a real problem for future growth prospects. 2, to my earlier point, beat your forecast. Put in manageable forecasts that you can actually do. And 3, stay patient if you do want to get back to growth, because you do need 2 solid years for us to say, okay, this business looks like it's in a healthy place and you can go forward. So don't try to force anything. Be patient and optimize your business.